Let me ask you a question. If a bank makes a risky loan, regulators can see it. If a public bond starts collapsing, traders can see it. If a stock gets destroyed, everyone sees the red candle and immediately starts posting like they personally discovered capitalism is fake. But what happens when trillions of dollars in loans move outside the banking system, outside public markets, outside daily pricing, and into private funds where nobody really knows what the assets are worth until something breaks? Congratulations, you have discovered private credit, the financial market equivalent of putting a suspicious smell in a locked closet and saying, "Good news, the room smells fine now." Private credit sounds boring, which is usually how finance hides the fun disasters. It is basically lending done by private investment firms instead of banks. A company needs money. A bank says, your debt looks spicy. A private credit fund says, perfect, we love spicy, and writes the check. And over the last decade, this market has exploded. In 2010, private credit was a few $100 billion. Big, but not exactly hide your children and your pension fund. Big. By the mid-2020s, estimates put it around $1.5 to $1.7 trillion globally, with forecasts pushing it toward $2 trillion and beyond. That is not a niche anymore. That is not a side quest. That is a full economy wearing sunglasses and trying not to be recognized. And the weird part is, almost nobody outside finance talks about it. Everyone argues about Nvidia, Bitcoin, gold, interest rates, housing, whether the Fed knows what it's doing, and whether Jerome Powell is just a man trapped inside a Bloomberg terminal. But private credit? Barely a whisper, which is strange because this market has become one of the most important places money is being created, borrowed, recycled, and hidden. So today, we're going to talk about how private credit became huge, why everyone suddenly loves it, why it looks safer than it might be, and why the next financial problem may not come from the place everyone is staring at. Because the thing about risk is, it does not disappear just because you moved it somewhere with nicer PowerPoint slides. Here's the official story. After the 2008 financial crisis, banks were forced to become more careful. Regulators looked at the banking system, saw the financial equivalent of a college apartment after spring break, and said, maybe we should add some rules. So banks had to hold more capital. They had to be more careful with risky loans. They had to explain themselves like a teenager coming home at 3 a.m. And because banks became more cautious, a gap opened. Companies still needed money. Private equity firms still needed debt to buy companies. Investors still needed returns, and pension funds still needed something better than boring bonds, yielding the financial equivalent of room temperature soup. So private credit funds stepped in. They said, we can lend directly, we can move faster, we can customize the loans, we can charge higher interest. Everyone wins. And for a while, everyone did win. Companies got money, private equity firms got financing, investors got juicy yields. Asset managers got fees, and banks got to say, not our problem, which is basically the adult version of moving laundry from the bed to the chair. Private credit became the perfect product for the low-rate world. When interest rates were near zero, investors were starving for yield. Government bonds paid almost nothing. Savings accounts were a joke. High-grade bonds were boring, so big institutions started looking elsewhere. Private credit came along, offering returns of 8%, 9%, sometimes 10% or more. And when someone offers a pension fund 10% in a world where safe assets pay 1%, the pension fund does not say, let's carefully think about systemic risk. It says, where do we sign? Because pension funds have promises to keep, insurance companies have liabilities, endowments have spending targets. Everyone needs returns. And private credit walked into the room like a guy at a party saying he knows a secret blackjack strategy. Now, to be fair, private credit is not automatically bad. That matters. Some of these loans are genuinely useful. Some companies cannot access public markets easily. Banks are not always the right lender. Private funds can be more flexible. They can structure deals better. They can work directly with borrowers. This is not crypto, where half the industry is a Discord server, a frog logo, and a guy named Brandon telling you the roadmap is community. Private credit finances real companies, real cash flows, real assets, real jobs. But here's the thing. Real assets can still be overpriced. Real companies can still be overleveraged. Real loans can still go bad. And real investors can still convince themselves they found free money because the chart is smooth. And that smooth chart is the entire problem. Public markets price things every day. Stocks move every second. Bonds trade. Prices update. Everyone can see pain immediately. Private credit does not work like that. A private loan does not flash red on your phone at 9:31 a.m. It does not collapse 12% before lunch and ruin your day. It sits in a fund report, calmly marked at a value that may or may not reflect reality. That makes private credit look stable, but sometimes stable does not mean safe. Sometimes stable just means nobody has turned the lights on yet. It is like owning a house but refusing to check Zillow, ignoring the leaking roof and saying, "My net worth has not moved." Technically, sure, emotionally, beautiful, financially, maybe seek help. This is one of the reasons institutions love private credit. The returns look smoother, the volatility looks lower, the portfolio looks calmer. But if something is only less volatile because nobody prices it honestly every day, that is not magic. That is accounting with mood lighting. And this is where the incentives get interesting. Private credit funds earn fees on assets under management. The more money they raise, the more fees they make. Investors want yield. Borrowers want money. Private equity firms want leverage. Nobody in this chain is rewarded for being the person who says, "Maybe we should all calm down." That person does not get promoted. That person gets uninvited from the conference in Miami. So the machine keeps growing. Private equity buys a company. The company takes on debt. A private credit fund provides the loan. Institutional investors fund the private credit fund. The private credit fund earns fees. The private equity firm gets its deal done. Everyone celebrates. And the company, well, the company now has to carry the debt like a backpack full of bricks. That was fine when interest rates were low, but then rates went up. For years, borrowers lived in a world where money was cheap. Debt was like air. You could refinance, extend, borrow more, and pretend math was optional. Then rates jumped from near zero to around 5% in the United States, and suddenly the same debt became much heavier. Imagine buying a house because the mortgage looked affordable, and then your payment rises so much, your budget starts making hostage videos. That is what happened to a lot of leveraged companies. And many private credit loans are floating rate loans, meaning the interest cost rises when benchmark rates rise. That is great for lenders at first because income goes up. Investors see higher yields and start clapping like seals at SeaWorld. But the borrower is on the other side of that trade. Higher yield for the lender means higher pain for the borrower. And if enough borrowers start struggling, the question becomes very simple. Are these loans worth what the funds say they are worth? Nobody wants to answer that too quickly. Because if you mark loans down, returns look worse. If returns look worse, fundraising gets harder. If fundraising gets harder, the machine slows down. And if the machine slows down, everyone suddenly remembers this was not a risk-free income product. It was lending to leveraged companies during one of the fastest rate hiking cycles in modern history. Tiny detail, easy to miss, only affects the entire business model. Now, private credit defenders will say, relax, these loans are senior secured, they have collateral, they are negotiated carefully, recovery rates should be better. And maybe they are right, but that is also what every credit boom says before the cycle turns. In 2006, people said subprime mortgages were fine because housing was diversified geographically. In 2007, people said structured credit was safe because the risk was sliced and distributed. In 2021, People said SPACs were democratizing access to growth companies, which was a polite way of saying, here is a PowerPoint company with no revenue and a CEO wearing Allbirds. The problem is never that investors believe there is no risk. The problem is they believe the risk has been engineered into submission. Private credit has its own version of that. The loans are private, the marks are smooth, the yields are high, the borrowers are monitored, the structures are negotiated, the managers are sophisticated. And all of that may be true, but sophistication does not cancel the credit cycle. At the end of the day, a loan is still a loan. Someone borrowed money. Someone has to pay it back. And if the borrower cannot pay, the lender has a problem. Finance loves to make this sound complicated because complicated things justify higher fees, but the core mechanism is brutally simple. If companies borrowed too much money at low rates and those rates reset higher and earnings slow down, defaults rise. That is it. No need for a 90-page white paper written by someone named Preston with a Patagonia vest. The danger in private credit is not necessarily that the whole thing collapses tomorrow. That is usually how bad predictions are made. Someone sees a risk, screams crash, makes a thumbnail with fire, and then gets humbled by 6 more years of bull market. The real danger is quieter. The danger is that losses appear slowly, that weak companies get extended instead of restructured, that valuations stay polite for too long, that investors think they own something stable when they actually own something illiquid, that everyone discovers the exit door is smaller than expected at the exact same time. Because private credit funds often lock up investor money, you cannot always just click sell like you do with a stock. Liquidity is limited. That is part of the deal. And in normal times, nobody cares. In normal times, illiquidity is called patient capital. In bad times, illiquidity is called, why can't I get my money back? Same feature, different mood. This is why private markets can feel so safe on the way up. The prices do not move much. The statements look calm. The fund updates sound professional. Everyone uses phrases like resilient portfolio and disciplined underwriting, which is finance language for please do not ask too many questions. But when stress hits, private markets can reprice violently. Not every day, not gradually, sometimes all at once. That is the uncomfortable truth. Private credit may not be a scam, it may not be a bubble, it may not even be the next crisis, but it is absolutely a place where risk has migrated. And migrated risk is dangerous because people stop watching it. The 2008 crisis was not just about bad mortgages, it was about where those mortgages went, into securities, into off-balance sheet vehicles, into institutions that thought they were protected, into places where risk looked distributed, diversified, and controlled, until it was not. That does not mean private credit is 2008 again. It is not the same structure, it is not the same assets, it is not the same banking system, but history does not need to repeat perfectly to punch you in the face. It just needs to rhyme. And the rhyme here is simple. When money is cheap, lending standards loosen. When yield is scarce, investors reach. When a product looks smooth, people assume it is safe. When everyone is making fees, nobody wants to stop the party. And when the cycle turns, everyone suddenly becomes a risk manager. Beautiful timing. So what should normal investors actually take from this? First, high yield is never free. If something pays more than safer assets, there is a reason. Maybe it is illiquidity. Maybe it is credit risk. Maybe it is complexity. Maybe it is all three wearing a trench coat. Second, smooth returns are not the same as low risk. Sometimes volatility is real. Sometimes volatility is just hidden behind private marks and quarterly reports. Third, when a market grows from a few $100 billion to over $1 trillion in roughly a decade, you should at least ask who is borrowing, who is lending, and who is pretending they understand the downside. Fourth, private markets are not automatically safer because they are private. That is like saying A restaurant is cleaner because the kitchen is behind a wall. And fifth, the next financial shock rarely comes from the thing everyone is already panicking about. It usually comes from the place everyone has learned to treat as normal. That is why private credit matters. Not because every private loan is bad, not because every fund is reckless, not because the entire market is about to explode, but because the system has quietly built a massive lending machine outside the places most people know how to monitor. And maybe it works. Maybe private credit handles the next downturn just fine. Maybe defaults rise but stay manageable. Maybe lenders recover enough money. Maybe the big asset managers prove they really did underwrite carefully. That is the bull case. The bear case is uglier. Rates stay higher for longer. Earnings weaken. Borrowers struggle. Funds delay marks. Investors get nervous. Defaults rise. Liquidity dries up. And suddenly the market that looked calm starts acting like someone finally opened the closet and found the raccoon. And then there is the most realistic case. Not a dramatic collapse, not a clean victory, just years of slow pain, quiet restructurings, extended maturities, lower recoveries, awkward investor letters, funds explaining that the losses are idiosyncratic, which is finance for please do not notice the pattern. That might be the real story, not a bomb, a leak, and leaks can still destroy a house if everyone keeps calling them moisture. So where do you land? Is private credit A, a smart evolution of lending after banks pulled back? B, a hidden credit bubble dressed up as yield? Or C, one of those things that looks fine right up until everyone suddenly claims they saw it coming? Drop your take in the comments. Because one thing is certain, when trillions of dollars move into a market nobody can see clearly, the story usually does not end with everyone calmly agreeing the risk was priced perfectly. Thank you so much for watching. Please comment, like, and subscribe if you like our video. Hope to see you again.